Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. I'm once again joined by good friend Doug Heagren. Hey, Doug.
Hey, Kirk, good morning again. And also welcome to everybody who's listening and joining us for today's conversation.
Yeah, I'll have to take the marbles out of my mouth. It's still early. I'm sure I can have plenty of fumbles after this. So Doug, let's kind of get started. We went through. We got a lot of comments back from our episode last week on clean versus dirty energy, and how we're all going to be screwed because of what's going on, and how dirty energy is going to save us. We got a lot of hate, a lot of love, and a lot of in between. So thank you all for those of you who sent in your comments. This week we're going to do something a little less emotionally charged, so we'll probably get a lot less love and hate, but that's all right. So this week we're going to get into cycles. So if you think about society, you think about culture, you think about economics, you think about any sort of big category, history, everything works in cycles. And there's actually a lot of reason behind this. There's actually a good book called The Fourth Turning by Howard and Neil Strauss, and I forget the other guy's name, but this book was fantastic. And it talks about historical cycles that approximately every 80 to 100 years we go through a full cycle. And if you look at wars happen during one of the cycle traditionally. Like every fourth cycle, which is about every 20 or so years, you get a war, which kind of lines up with some of the challenges we had 80 to 100 years ago. So the point is if you understand history, you will hopefully not repeat it, right? Everybody makes mistakes in history, and there's one, I forget what Warren Buffett said. He said if there's one lesson we can learn from history is that people don't learn from history, which I think is very apt.
It's a good comment.
Yeah. So I think one of the things that we try to do in the show is not tell you what to think. Like a lot of analysts, a lot of experts, they're out there saying, oh, you got to do this because of X. No. I'm not going to tell you what to do. That's not my job. My job is to educate you so you know how to think about what to do. So if you're armed with great information and background and ways to think about things, you will make better decisions. So I'm going to start off here with one chart, and then I'm going to go back to Doug, and we're going to tie right in. So I had this one chart because I thought it was really interesting because it's a recent chart. And as I'm technologically inept, I will eventually get this up. Here we go. So if I look at this chart, these are long-term trends. And if you look at the dates, they're really not long-term. So my apologies, but I'm using this to illustrate a point. So if you look at these trends, one of them, the dark blue is bonds, the light blue is stocks, and the yellowish gold is commodities. Now, this is a very common cycle that you can see throughout history, is that, through these different categories, and these are really the three main categories that people look at when it comes to traditional markets. I'm not talking about real estate. That's very different. So, if you look at bonds, if you look at this chart, bonds have tapered off early, right? You're looking at last year. And then equities started to taper off January of this year. And then commodities are still kind of flatlining. They haven't tapered off yet. But the point is if you look at these charts, you'll notice that they don't operate all the same. Sometimes they do, sometimes they don't. If you look back at 40 years history, you'll notice that they do not operate this same way. But you can discern a lot from looking at market cycles. You can say historically, here's a relationship that is normal, and here's a relationship that's not normal. Now, these three operate independently, but if you're seeing a major downturn, you will typically see all three operate in a way that is uniform, right? Versus sometimes, if let's take right now, everything was really expensive as of the end of last year. And then bonds started to go up because inflation was higher. And then stock prices started to go down because inflation's higher. Commodity prices are still high. We'll see where that goes. They might continue to go higher. We'll see. But the point is you can look at these charts, and these are bigger picture. This is not day to day. If you look at some of the shaded, the lighter color underneath, you'll notice that these lines are, I think these are the 200-day moving averages. But it's basically, it's aligning with the chart underneath. So if you look at bonds have actually picked up recently. but they've been in a strong downtrend, and it's going to take a little while for that bond line to turn up. But you'll notice below that bonds have really gotten decimated in the last 2 years. Equities, they're not quite there yet. We may see more of that. So, Doug, what are your thoughts when it comes to cycles?
Well, when it comes, my thoughts when it comes to cycles, I mean, there's a lot of different trends that happen out there. I mean, there's some saying, statistical saying that said, and this comes from, whether you agree with it or not, modern portfolio theory, was that
Humbug.
yes, exactly, right. But they found that something like 90 some percent of all performance was tied to diversification, and that left 8% of the rest of the performance tied to world events. It tied to news, tied to wars, whatever it might be, political things like that. So what I see from that aspect is that, again, it still kind of matters to what you're in, right? And cycles, the thing about cycles is it kind of is, it's almost like the ultimate form of the equilibrium of the animal kingdom, right? If you end up getting into a situation where something is so good, okay, then resources will be allocated to that in a way that will ultimately drive the price of that resource. The demand will be higher, but there'll be more investment in it. That'll potentially drive the price of it down. All of a sudden, there becomes an overconsumption of that. And then all of a sudden, it kind of just burns itself out, right? You have too much. When things get too, it's kind of like a balloon, right? If you expand it too much, it stops lifting. All right. So what happens is you're going to have movement, whether it's from computers or investors or economic cycles or world cycles, that things are going to move, that people are going to move their money when things get to a certain point into other things. So cycles are inevitable because at some point they start to feed themselves out. I mean, if you think of a deer population that's just exploding because there's so much to eat, but there's no wolves anymore. Well, eventually the deer get to a point where they eat all the food, and now the deer population starts to decline, right? And if the deer population starts to decline, well, then all of a sudden what happens to the foliage in the area? It starts to come back, right? Because there's less pressure on it. I think to some degree, cycles kind of work that way as well. Is that, there's only so high things go. Let's take commodity prices, for example. Let's take gasoline, for example. We go back, we talked about this in one of our recent conversations about how expensive gasoline got, back in the 2000s when they were talking about how we were going to run out of it. And so, all of a sudden it got to the point where, I mean, we were looking at $130, $140 a barrel, and you were looking at prices kind of similar to now, right? $4 or $5 dollars. But at that point, people couldn't really afford it anymore, right? Money, we all have made more money, even though incomes haven't kept up with the cost of other expenses. We all make more money. So $4 or $5 today feels differently than $4 to $5 20 years ago. That's just a fact. So it got to the point where, in order to keep up with the pricing of gasoline, people had to shift their money from different things, and they had to start cutting back, and it started to capitalize on the rest of the economy. And that ultimately led to a point in which other things that had been doing well started to do poorly, and it kind of started to become a catalyst to an overall recession. Other things started to kind of drive negatively from that until all of a sudden, when we started going into a recession, there was less consumption of the petroleum, the petrol products anyway, because now most of that is not gasoline. It goes into manufacturing. And guess what happened? Prices all of a sudden came back down. It almost got to a point where it was an unsustainable level of value, to the point where it became negative upon itself. And if we start to look at the opposite of that, when there was all this, exploration of oil shale a couple of years ago, and you go look at the Balkan fields, got to the point that, America became the number one producer of oil in a very short period of time. Well, now you're flooding supply. That drove the price of petroleum down to the point at which all it took was a little bit of a catalyst. Now, we call COVID probably more than a little bit of a catalyst, but all of a sudden it was already so inexpensive. Now you could sell oil for such a cheap price at this point because there was so much oversupply that it started to that all of a sudden it took a little bit of a movement, a little bit of a shift, and all of a sudden it drove tons of those companies out of business. Nobody could afford to go make oil exploration anymore. And then what happened to the price of oil? Back to the toilet, right? So that's a perfect example. The other thing I wanted to say just from the other chart that I thought was really interesting, just really quickly looking at that, is that if you look at 2020 when COVID hit, you saw fixed income, you saw stocks, and you saw commodities all drop. And then since then, you've kind of seen them kind of kind of come back at different periods, different levels. And there is a saying you've probably also heard, Kirk, too, is that one of the biggest problems of diversification is it tends to work really well in up markets, but terrible in down markets. In other words, things correlate really, really quickly when they're falling, which is why just trying to rely on typical diversification can end up putting you in a position where you're not making money when times are good, but you lose just as badly when times are bad. So I think that's also part of the things I saw on that chart as well.
Yeah, no, you raised some great points, Doug, and I think that just kind of touching on some of them, and we'll go into some other charts, is that the oil is a great example of this. Is, I think it was 2005, 6, 7. We had this. We're running out of oil. Scare. We're going to run out of oil, and so oil prices went through the roof. Natural gas went through the roof, and then what happened? Well, technology prevailed, as does in any circumstance where we think of running out of something. Technology prevailed and we came up with fracking. And now we have more oil and gas than we know what to do with. We are the largest, I think we're the largest producer of natural gas in the world. Now, we weren't before, but now we are. And people they're flaring it off. They're basically wasting it because we have so much of it. So, technology prevails because what happens is when us human beings, when we run out of something, we come up with a better solution or another solution. We're innovative, but only when we have to, right? If it's, they say the cure for high prices is high prices. The cure for low prices is low prices. And the meaning behind that is if there are high prices, people come up with a profitable way to come up with more supply because it's profitable, right? Oh, really? Oil's $200 a barrel? We'll find a way to drill more oil. $200? Absolutely. Until too many people do it. And now it's back to $20 a barrel. So if you look at, what happened in the early aughts, if you look at pretty much this decade as well, or the last decade, we had similar things where oil prices are up in the hundreds, then they went down to the 20s, and actually the future prices went to negative 20 at one point during COVID. So all of this being said, there are times when things are in excess, and there are times where it's at the opposite end of the spectrum. And I want to share this because I think it's really important to see. A lot of this is based around emotion. So cycles are based primarily out. A lot of it's supply and demand. All you economists don't want to shirk your duties there, but most of it's driven by emotion. Now, this is the cycle of market emotions. In some ways, it's meant to be a little bit humorous, but it's also kind of true. If you look at kind of the start, it's optimism. It goes up to euphoria, then it goes to fear, then it goes to despondency and depression, and then the cycle starts over again. So the point of this cycle is if you think about past cycles. Now, most people in the market have never seen a recession or really bad bear market. Even like 2008 and 2009 are examples. A lot of people haven't seen that. People who've seen it, they get it. They probably remember how they felt, and that didn't feel very good. That's assuming that you were paying attention. A lot of people just decided to not look at statements for 3 years. But if you think about like that emotional roller coaster, right now, as of last year, people were in euphoria. Everything was great. We're in a new paradigm shift. I know a lot of people talk about that. Hey, it's a new paradigm. There's a lot of greed, a lot of delusion. Oh, we're gonna make some of these meme stocks profitable again. Yeah, okay. But or NFTs or cryptocurrency, and those who listen to the show know that we're not down on any of that stuff. We're just saying like these are signs of the top. If you look at the early '90s, the internet boom or the tech boom, I should say, because there was computers and there was the internet, and there was a lot of disbelief. This stuff is never going to make it. These are just for gamers, for kids. Only kids are playing games online. You can't do anything functional with the internet. And what happens? Well, people start to see the relevancy of the technology, and all of a sudden it starts to be widely adopted, and then it starts to take off. Just like blockchain and cryptocurrency. if I'm looking at this this chart right here, which just shows a typical cycle. So we got the stealth phase, which is where the smart money comes in. It's where the early adopters, the experimenters, the people who try everything, and some stuff makes it and some doesn't. I think blockchain is a trend that's going to do really well, but it started in 2008. So we're not early. The institutional investors started to get in the last few years, and then the public got in, and the public drove it up, and it hit a peak, and now it's down, and people are in despair, and they want to dump everything. They think the world's going to end. I don't know what's going to happen, but this has happened many times before, and you know what? It's going to happen again, and again, and again, and again. This is a normal cycle of the markets. If you understand this, and you look at this and you say, all right, people are saying it's a new paradigm. That's probably a bad sign, right? Oh, this time is different. It's a new paradigm. Everything's great. There's no risk. That's the time you want to maybe take some money off the table, right? And then you look at this typical thing where people are in denial. Then there's a bull trap, and they're like, "All right, we're going to buy." And we've seen a bunch of bull traps this year in the market where the market's gone down, and people start pushing up. All right, great, we got a good price, and it's going to go to the moon. And then it goes up 10%, and then it goes down even more. And then it goes up, and then it goes down. This is normal, and so we're trying to. I know a lot of listeners are looking to us to learn more, so we're trying to educate people on the bigger picture stuff that applies in a mental framework for how you should be thinking about things. So if we look at these emotional market cycles, this is these are things that you need to understand. So I want to touch on one more thing, and I'm going to let Doug talk a little bit. So here's an example of this. This is a chart of the largest U.S. companies based on market cap for the last 60 years. Now, if you look, many of these companies continue to be in the largest section of companies in market cap. AT&T has been in there for a while. IBM's been in there for a long time. Microsoft, General Electric, Walmart. There's a bunch of companies that have been in there, and there's companies that go in and out, right? If you look at the most recent, Berkshire Hathaway has been in for the last pretty much the last 2 years, but prior to that, it wasn't. Johnson Johnson. You have a lot of rotation, right? So there's some companies that go in and out, but there's definitely a lot of rotation depending on when you're looking at this. So 2000, obviously, a lot of tech companies like Lucent, they're not even around. AOL, not even around. Citigroup was obviously merged. So if you look at some of these aren't even around because of merger or even bankruptcy. However, what's important to take away from this is that cycles change, companies change, and if you're just buying and holding forever, that may not be the best strategy, right? Like, look at some of these companies in the 60s, Sears and Roebuck, where are they? Eastman Kodak, where are they? Right? Texaco, well, I guess they're probably technically still around. Xerox. If you look at these companies, there are a lot of companies that aren't the same company they used to be. So what you should take away from this is you should always be looking at your portfolio. Make sure the companies you own are continuing in the direction you expect them to go, or find other companies that'll do a better job. But this is also an example of market cycles that if you don't understand market cycles, then if you own something for 40 years, you might be disappointed that in the next 40 years it's not going to do great. So, Doug, thoughts?
Well, going back to the charts you were showing about the investor emotion cycle, I think there's actually the chart you showed is a great chart, and I think what I also kind of see in the well, let's go back to the cycle of market emotions that you were showing, the one that was kind of kind of cartoonish. I think it does a really good job of kind of showing what people are going through visually at those times. And if you follow where it starts and ends on optimism, right? And then so it goes from optimism, excitement up to euphoria. Then it kind of slowly degrades down to the bottom pit of despondency. And actually, interesting enough, just depression comes later, then hope, relief. I mean, you talk about the cycles of grief that people go through. There is a lot of losing money in the markets and making money in the markets can very much follow the cycles of grief, euphoria, fanaticism, death. Okay. Well, what's interesting is you look at it, the problem that people run into, okay, is that Notice that in the middle is optimism. Okay. So they're excited, optimistic. People tend to make moves when they become optimistic about what that move's going to make. So they go from optimistic, excitement, thrill, euphoria, and then all of a sudden anxiety and denial come in, fear, desperation. All of a sudden you see panic come in. Panic comes in lower than optimism. And then it continues to get worse to capitulation, despondency. Then we start coming up to depression. Now they get back to hope, relief, back to optimism. What does the typical person tend to do? They tend to want to finally get in the market when they're optimistic about that. But look how far off the bottom they are at the time that optimism may start to show. So you start looking at, let's look at Bitcoin. Okay. Bitcoin a couple years ago, was, up $70,000 for a share of Bitcoin. How many people were jumping into it at 40,000, right? They finally became aware of it. They saw how it was going. They got the fear of missing out. They had the optimism that as they were being told about crypto and FTX and all of these and Bitcoin and all of these different types of blockchain technologies, that it was time to get in because they did not want to miss out on $100,000 in value. Well, guess what happened? Okay. They got in at the optimism level. And then it started to dip and we're hearing that denial. It's coming back. The fear hasn't hit in yet. But by the time people then decide, oh my gosh, I've had too much at panic, they have decided to get out now when it's already near the bottom of the loss. Okay. So if you think about it, and they've talked about this before, Kirk, you know this, that they say if an investor just stayed in the markets, and we're not proposing that you do that, but if you just stayed in the markets during all cycles, you would do better than the average investor, which goes back to the other chart you were showing that talks about when the smart investor's in and then the smart money gets in and institutional investment gets in. By the time the retail investor jumps in, it's usually already achieved a significant amount of upside. And as you saw in both those charts, we are already to a point in which there is a potential for decline. By the time the masses jump in, goes back to what I've talked about before. Joe Kennedy said, I knew it was time to get out of the market when the shoe shine boys were giving me stock tips, right? I was talking to someone I saw someone the other day on social media, Kirk, who said that they had taken $150,000 from a sale of their condo. And they ended up taking that money and putting it into FTX and one other one. And the person wrote, I blame the same person for losing everything on both of those. Now, a lot of people don't know what to say, right? It's like, well, we shouldn't put money in that you couldn't afford to lose. When did you put it in? Again, they were chasing those returns. People get in when it's too late, and they get out when it's too late, and they lose all of that. So therefore, that's where it comes back to the average investor not doing anything, made 7-8%. The average retail investor jumping in and jumping out only made 3% because they don't know what they're doing and they let those emotions rule. I saw some responses, which I don't know if this is the denial stage or what, but somebody wrote back, well, why would you have put your money in this? You should have just put all your money in Bitcoin. So I had a conversation with this person. I said, you're not giving this person any good advice here. You said the person just lost their money and you're saying, why would you put in Bitcoin? A lot of people jumped on me and said, well, because between 2000 and present, or 2010 and present, it grew 1,400% or $14,000 a share. So wait, so do you drive looking in the rear view mirror as well? Do you make your decisions based on the things you've already passed, in order to decide what cars not to hit in front of you? He didn't get it. Had no clue. Absolutely no clue. He's like, where are you getting this? I don't see how my driving has anything to do with that. I said, it's because you're using those past results and assuming that you're going to get the same thing again. And maybe you're right. Maybe you're not. That's speculation. But you've got to make sure that you're making these financial decisions without emotion, with logic. And if this gentleman sold his condo and he's got $150,000, he shouldn't be putting all of that into Bitcoin, even if Bitcoin becomes $100,000 a coin in the future, because all he's doing is making decisions on speculation. And speculation is really what comes in the cycle. Because by the time you get optimistic, Kirk, now you're all of a sudden less concerned about what could happen on the negative. All you care about is where it could go to. And by that point, you've already cut yourself on a lot of that opportunity, and you're setting yourself up for disaster. Okay. You've got to make logical decisions. That's why the smart money gets in earlier. That's why institutional investors get in earlier. And by the time the retail investor figures this out, they are making decisions strictly off fear of missing out and emotion. And that is a general disaster for your financial future. You've got to have a disciplined, logical process in how you decide what to hold, when to hold it, and how long to hold it.
Yeah, so I want to point out a few things about the cycle. We'll move on to other charts here. You were talking a lot about FOMO, Doug, and FOMO. It's funny. FOMO typically comes in near the top, comes in around the thrill stage, right? Excitement is when you're like, "Yeah, I'm doing well." FOMO is like, "Oh my God, everyone else is doing well. I got to get in this." And of course, as you notice, FOMO is right near the top, and FOMO is actually the opposite of capitulation, in my opinion. Capitulation is when you've ridden it all the way down. You're like, all right, I'm done. All right, pain point, I'm done. You tap out. And then, of course, you're right near the bottom at that stage. And if you think about it, and I try to be very mindful about, I mean, sometimes you make good investments, bad investments, but I try to be mindful about how I'm thinking at these turning points. If you think about 2020 is a good example, like, wow, the market's down a lot. And what are people feeling? So I talk to, as you do, Doug, I talk to a lot of clients and get a feeling of what they're thinking. And, it gets into this. We talked about this book the other week, The Survivors Club. It talks into the 5 stages of grief, right? And, certainly denial, anger, depression, it's not called negotiation, but anyway, so there's the 5 stages. And if you look here, more or less they're here, but you see this changeover. Capitulation is like, all right, I'm done. And then you don't want to get back in. And then the market goes back up and you're sitting in cash because you get out at the bottom. So this kind of comes back to risk management. Like if you don't have risk management, so that chart that Doug talked about, which which I'll show here really quickly, but the chart that Doug talked about was one that I actually put in my presentation. It's famous, but it's from 1986, right? It's diversification is the best way to manage risk. Well, according to this, asset class selection is 94% of the returns, and asset selection and market timing are very small percentages. Oddly enough, this is at a time that was very different from the market now. And this also is at a time where diversification worked. I would argue that if they redid this study today, you wouldn't get these same numbers because it wouldn't happen, right? Because now when the markets go down, like they did this year, like they did 2020, 2008, when the markets go down, they go down altogether, right? So there's a difference between volatility and risk. And so 2020, oddly enough, was a bad example because that was actually volatility. But typically, if you're looking at a chart, there's a difference between volatility and risk. Risk is when the market goes down 50, 60%. Volatility is this, it's this bounce we get every year. Maybe it's up and down 5%, 10%. That's volatility. Volatility is what you're trying to smooth out with diversification. That's what diversification is for. It's not for risk management. People call it that. It's not risk management. It is volatility management. It's a way to smooth the ride so it doesn't feel like you're as bouncy. It's like going out and deep sea fishing. Do you want to go out on a ocean that's like glass, or do you want to go out with one that's in the middle of a storm where you're going to tip over? Well, obviously everyone wants it to be glass. So diversification helps with that. Now, if you're looking at risk management, if your stock goes down 70, 80%, that's a risk. That's what we call permanent impairment of capital. Now, that's the term we use. It doesn't mean it's permanent, right? I mean, Bitcoin's a good example. Anytime it crashes, it goes down 70% on average in each cycle. And then it goes up a few 100%. Then it goes down 70 and goes up a few hundred. That's a normal cycle for Bitcoin. Not saying it's good or bad. I'm just saying if you look back at history, that's what it's done. So if you're not expecting that, then you might be a little surprised. So understanding the difference. So for Bitcoin, that may be volatility, right? Risk would be going to zero, which of course is always a risk, but with new technologies, and you have to acknowledge that. But I think right now, this still falls within the norm of volatility. Unfortunately, you can't really diversify away from that because all coins kind of operate together. They're very highly correlated. So I wanted to show this chart here. this is a history of the Dow Jones Industrial Average going back to 1896. So that's a long time. So I wanted to point this out because if you have a perspective on history, it gives you a better ability to navigate it. So I don't think people realize, they just look at their statements and say, oh, I'm up 6%, I'm up 10%, I'm down 10%. But if you look at the chart, this shows the price movement, right? So when people talk about, if you go back to like 100 years ago, you'd say, wow, the market has gone up a lot in the last 100 years. You'd be correct. But over that 100 years, it's done a lot of things. So if you look at, early 1920s, wow, the market skyrocketed from 1920 to 1929. It was up, I don't know what it is on here, but hundreds and hundreds of percent. Oh, and then it dropped 90%. So maybe it wasn't so good, right? But if you look at the bubbles and then you look at the recovery time, it was 25 years to recover from the 1929 market crash. And then in the 70s, the late 60s to the early 80s, the markets went up and then they went sideways for that period. That was a time of high inflation, but the market went sideways for around 16 years. And although this chart doesn't do it justice, the pretty much 2000 to 2013 was also a sideways period. That was 13 years. This says 6, but technically I would say it was 13. And so if you look at these time periods, visually you can see there's sideways times and there's bull market times. Now, right now, you can see that obviously we've hit a pretty good bull market, but I think it's clear to everybody except for people who are not really paying attention to anybody but the newscasters, that we're going into recession, and even the Fed is saying we're going to create a recession for you. So we'll see another period of recession where the markets go down. But I think what's important is just looking at these and giving you a perspective of how history works and how markets work. So if you think the markets only go up, you might look at it and say, okay, I need to change my perspective a little bit. And I think this is a great job of doing that. So what are your thoughts, Doug? I mean, it looks like there's 120 different events here, and yet the markets still go up, which is kind of the point of this, right?
Yeah, well, I mean, the markets do go up, and I think that goes back to kind of what I was saying about the average, the belief of the average investor versus the belief of versus the actuality of someone staying invested in the market. Again, if you're going to use emotion, and by the way, Kirk, as you were trying to come up with that, the 5 stages of grief are denial, anger, bargaining, depression, and then acceptance.
Bargaining, that's the one I always forget.
Yeah. Bargaining and yep, exactly. So if you're going to use emotion and you're going to, and I talked about this in a previous episode, if you are fearful of what you are missing out on, okay, that is an emotion. And that same emotion will come to play when you start to lose money. You'll become fearful of losing what you have. The instant that you start making any decisions based off of nerves, we cannot control our emotions. That is a fact. What we can control is our response to our emotions. So if you find yourself in a place where you can no longer control the response to the emotions, you should not be handling the decision-making of that situation. And this is exactly why they say doctors don't do surgery on their own families, right? Because there's an emotion in there that will make it incredibly difficult for a doctor who must remain emotionless and logical throughout the surgery will be compromised when they realize that one wrong mistake on the table could kill someone that they love. Okay. And so they may not be fully there. So that's why the argument is, if you are going to be emotional about this and you cannot control your ability to be emotional, then you should just stay invested. Okay. Because that's option 1. Option 2 is to seek the help. Okay. Outsource that. A doctor will have another doctor do surgery on their family. Okay. And the reason for this is that, well, yes, staying in the markets will prevent you from getting in and getting out at the wrong time emotionally, which is a disaster. If you go back and you look at the history of the market here that it's showing, yeah, over the long run, and this, people love to tout this all the time. They love to say, hey, see what the return would be if you had just stayed in it. But the next level of this, Kirk, comes back to what you just showed, which is time, right? If you go in and you look at a recovery time of 19 years, a recovery time of 25 years, a recovery time of 16 years, a recovery time of 6 years, as it shows on that chart. Yes, you're making money. Yes, you will grow, but your problems will compound with it. So doing nothing will everybody's going to make more money. Everybody's circle of wealth there is going to grow, but problems compound with it. What is one of the problems? Yes, over the 30-year period between 1900 and 1930, you made money, but the 19 years you didn't. What people don't realize is they lost money during that time. Okay. They think, well, look, the end I was more. But if you are looking at compounding, you're looking at getting a rate of return. If you're predicting your retirement or your future of being able to buy a house, major purchase, invest in a business, whatever you're trying to do, and you are looking at a required amount of growth, whether it's through your savings or whether it's through the markets, all those years that you don't get that work against you. And the only way to overcome it is not to just get back to a positive situation, but you really have to go back and put the money in that you didn't put in before, including all the return you would have gotten then. So if you lose 13 years, Kirk, or 25 years or 19 years of growth, you are not only losing the money that it would have grown, that you're getting your money back, but you're not getting your money back at a level it could have become had it been able to grow during that time. So just sitting in there is losing time. As Benjamin Franklin said, lost time is never recovered. You can't get it back. So if you were supposed to get 6% a year to achieve your goals during those 19 years and you didn't get it, you lost tens, if not hundreds of thousands of dollars of future value, and your entire situation could be compromised. If you did even worse and got emotional and decided to try to jump in and jump out without a process, without a strategy, based on emotion, based on feeling, the stats are out there. You're going to do even worse, which is why it does. We're not saying to stay in the markets throughout these cycles. There are times in which you absolutely want to be on the sidelines. You want to have capital on the sidelines that gives you, like Warren Buffett, an option to be able to get in when it is an opportunistic time to put money at play. But if you don't know how to do that and you don't have a process, then you need to either not do that at all or look for someone who does have that process, because that can be incredibly effective when implemented correctly. But because time disappears and you're never going to get that back. And that is a difference between success and not success. So, we're not saying here just be all in, invested all the time, but we're all saying don't make moves on emotion. And unfortunately, I don't know what this percentage is, Kirk, but I would say 90% of people, unfortunately, that's what they do.
No, I think you're right, Doug. I don't have the numbers, but I would say that most people make it on emotions. I mean, if you think about some of the most successful investors of all time and kind of what they say about it, Warren Buffett's always he's always the high watermark that people shoot for. Here's a guy who has a Wall Street kind of education, if you will. He chose to move to Omaha. He chose to move way the heck away from Wall Street because he knew that his emotions would be tempered with if he was around people all the time that were slinging emotion, right? I mean, people on Wall Street, they're slinging fear, they're slinging greed, because they know that those emotions are what drive people to make decisions. So he moved as far away as he could from the hustle and bustle and basically just sits in a room all day and reads annual reports. And, not taking anything away from the guy, but he's obviously found something that works for him and he's not baited by his emotions. Now, that's kind of an extreme example. I don't ever want to move to Omaha to do that. That seems a little extreme, but hey, to each their own. Then you have people who are day traders who deal with this every single day. They're looking at stocks and bonds and commodities moving up and down every day, and they have to battle with their emotions. So they come up with strategies in order to handle this. Some of the strategies are have hard and fast rules. Some strategies are use a computer and put in an algorithm or set of rules for the computer to do it for you. Some of the most successful and largest hedge funds and trading firms basically just put together algorithms that are based on history and calculations that they've done. And they say, here you go, let's turn it on. And the computer does all the work. And then they just go have drinks at 1 o'clock in the afternoon. Like once you remove the emotion, it's pretty easy. So I know some traders that I wouldn't call them emotionless, but they're in control of their emotion. They have their habits every single day. In the morning, I go in, I look at the market, I say, here's what I'm going to do today. And if this market does this, I'm going to do this. If it does that, I'm going to do that. And if it does nothing, I'm just going to sit here. And that's what they do. And to me, it sounds just mind numbingly boring. And it just sounds horrible. And I say that not because it is, because these people look at it as a job, right? If you're on an assembly line, putting rivets in a car, you're putting the same rivets in a different car over and over and over. To me, that sounds mind numbingly boring. But yet, you're doing productive work that's meaningful. And so, if traders are doing the same thing, so what? Trading stocks and bonds and other securities, it's not supposed to be fun. That's why you go to the casino, to have fun, unless you're a professional gambler. But for most of us, you go with a few $100, you go to have fun, right? And that's what you should be having. And yeah, granted, you're going to lose money, but the odds are stacked against you anyway. With the market, the odds aren't stacked against you. You can create your own odds. But if you're not in control of your emotions and you're trying to have fun in the stock market, you're going to lose a lot of money because the odds are stacked against you if you try to have fun in the stock market. So the emotions and how they appeal to all these cycles are really important. And we're bringing this up and we're beating this dead horse over and over today because this is one of the primal drivers of investing, of stock prices, of markets, of cycles. It's, I don't want to say 100%, but almost 100% based on emotion. And so if you really want to understand how to be a better investor, the first step is to better understand yourself and to know, like, I need action. And this is, I'm going to characterize different types of people and different personalities so you can recognize yourself. Some people want action. They go to the casino because they want action. They want more action. They gamble. They do this thing. They do that. They gamble in games. They gamble in casino. Whatever. They need action. So some people, they need to trade like 10 times a day because they want that action. I can't do that. I would burn out in about a week. Like, it would be fun for a day and then that would be it. I would burn out because it's just a lot of work. And some people, that's their mentality, right? So you need to find an investing strategy that aligns with your need for action. There are other people like Warren Buffett who need inaction, right? They have to seek inaction. But in order to do that, you have to have what some people call the anaconda approach, which is wait for that deer to drink from the water right next to you so you can go out and grab it. You're not going to chase a deer down, but if it's literally touching you, that's when you can grab it. So that's kind of an approach that some people like Jim Rogers talks about this. He says, I just wait till there's a pile of money sitting in the corner and I just go pick it up, which basically means that I do nothing until I see a really obvious play and I do it. Now, one thing I've noticed in my career is 1 to 2 times a year, there's going to be extremely obvious investment. One that's just, this can't be this obvious. And you step in, you're like, if you don't take advantage of it, you miss this like obvious decision like for the whole year. And that's it. Now, I'm not saying there aren't good, obvious investments throughout the year. I'm just saying what I've noticed is usually 1 or 2 really, really obvious ones, like trading on futures for like -$20. That's an obvious one, right? We're not going to stay at -$20. Now, granted, that's not how the futures markets work, but you're following my point. Like, there are points where things are obvious extremes, and you're like, all right, it's time for me to go in and buy some stuff. So I think the takeaway here is to understand yourself, to understand there are different types of investor psychologies, different types of investors, and you need to understand yourself. This is something we say on the show all the time. Know your investor psychology. There are no good or bad ones. There are only good or bad ways that you can apply it to yourself. Some people need quant investing. Some people need fundamental or technical or whatever it is. There are so many ways to do this successfully. Like, I know a lot of investors and almost most of them have very different strategies from each other and they're all successful. So it's not like you have to be Warren Buffett or you have to be, Carl Icahn or whoever. You just have to be yourself. But you need to know yourself and you need to know what type of strategy you can apply to yourself. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right. I said it. Free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here. See? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send them to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today. Now I'm going to share this one chart and go back to Doug here in a second. So I'm doing this for the sake of being unpolitical, and not that I'm not, but not that I am, but I think for the show I try to be, just because I think it's good to straddle lines so that everybody can understand the full picture and not just find find a bias that kind of aligns with ourselves. Because I think when you do that, you tend to, like conservatives align with Fox News, and liberals can align with CNN and MSNBC, and that's fine. But you're basically walking into an echo chamber where they're telling you what you want to hear. So our goal in the show is to open your mind into other things and to know that the world is not binary. It's not black or white. We live in the gray. So here's an example. A lot of people say, well, Democrats are better, Republicans are better. Well, here's the markets aligned with different administrations, with different presidents. So as you notice, they're all going up, right? there's no pattern of Democrats are good or Republicans are good, or there's a lot of randomness in there. And if you look at different administrations, you could say, wow, Clinton did better than Bush. Okay, but it could have been coincidence. It could have been the technology bubble that was happening. Could have been a lot of things, right? Or like Obama, you say, wow, he did really well. But yeah, he started at the bottom of the cycle where the markets were low. I'm not saying they're good or bad. I'm just saying a lot of this thing is coincidence. And what I've noticed with presidents, as an example, is they will take all the credit and all the blame for the stock market, and yet they have very little to do with it. And I know I'll get hate for saying that, but presidents across the board, there are things they can do, but there's very little they can do. They can do stuff to make things worse, but there's very little they can do to make it better. And so when you look at the history of markets, you notice that presidents, they're the president, they're the leader, and they're taking the credit or the blame. But realistically, there's a lot of little smaller decisions that happen in there. Like Congress passing a tax bill or raising tax or lowering them. Those have more to play than a president. And the president's not the one constructing the tax bill, they're just signing off on it. So I think it's important to recognize that while politics does play a role, and I think there's a lot to support the idea that when you have a divided government, that that the economy tends to do better, because it's not because that one side or the other is bad. It's because when you have a divided government, only the best stuff goes through. So if you have one party having all of the power, they're going to do what they think is right. That may not be the right thing, right? Democrat or Republican, doesn't matter. It may not be the right thing. But when you have to bargain and debate back and forth between parties, people come to terms somewhere in the middle, and that tends to be more accurate in terms of what the right thing is to do. Because you had to fight hard for it. And the other side said, I'll give because it's not because it makes sense. So you think of all the bipartisan stuff that goes through. Good example is the opportunity zones. That has bipartisan support. That's a great thing for investors. It's a great thing for disadvantaged communities. Both sides win. That got through because people came together and said, hey, this is a good idea. But if they didn't, then we wouldn't have this opportunity as investors. We wouldn't have these communities with new money coming in. So I think what history has shown is divided government tends to be the best for the economy. it doesn't mean that we're not going to go into recession or we're going to have a boom. It just means that overall, the better stuff gets through, so the bad stuff doesn't. And the bad stuff is what you worry about with governments, is that they pass something and it tends to screw up the economy, which we've seen over and over again is what tends to happen. So I don't know. What are your thoughts, Doug?
As always, I have plenty of thoughts. I think so. I've seen several charts on this. Again, I don't know causation. We always talk about causation, correlation. I have no idea where the political movement is going. Many people could argue that the Democrats of today are not the Democrats of the past. The Republicans today are not the Republicans of the past. Again, there's no exact science on this. But historically speaking, again, people are like, think their side is only going to do better. And I believe the hierarchy, although it's nominal, is that a Democratic president with a Republican Congress has been the most successful. A Republican president with a Democratic Congress has been the second most successful times in the stock market. And then an all Democratic president Congress is third. And the least has been Republican control across the board. Now, again, there's exceptions to all those rules. If we go to 2000 and 2004 under George Bush, the markets were all Republican control. Were up 24% during that time. Eisenhower, 52 to 54. We're up 29% during that time. And we look at times during, say, Roosevelt, all Democratic control, down 22%, 17%. So, I mean, there's exceptions to every rule here. And it's not a significant swing either way in terms of control. But what it is that there is, I think, going back to what you said, there is definitely going to be a correlation between having again, regardless of your political divide, having a split does tend to filter out the ability of kind of egregious or extreme things getting through in a way that may correlate to less of a good outcome for the economy. And so, you may think, well, geez, it's, really terrible right now that the Republicans have taken back over the House. It'd be better if you're Democrat, they were all Democrat, and the Republicans may feel the same thing when it shifts. From a economic wealth standpoint, that may actually be working for you better than you think it is if we look at history. The other thing I also wanted to talk about in correlations, you were talking about the boring, the simple, looking at Warren Buffett living in Omaha, getting away from the noise of Wall Street. There has been a call in recent years, and I say the last decade or so, of more and more public companies, Kirk, talking about taking their companies back private. And one of the reasons for that is, again, getting away from the emotion, getting away from short-term thinking, which has now really become, in this day and age of retail investment, where everybody has access. You're seeing more and more decisions made on what can you do for me in the next quarter. And Wall Street is and I'm seeing this in major companies. They're now looking quarter to quarter. They're not necessarily looking long term. So they will make cost-cutting measures or strategic moves that don't necessarily benefit them from a long-term outlook. Maybe it reduce, it's an investment in the wrong things. Maybe it's letting into intellectual capital go, all because of Wall Street saying, well, we're going to tank your stock if you don't meet this metric next quarter. And that short-term thinking can be very, very dangerous. That is an emotional thinking. It's making money for me now. Stock options for leaders are tied to that too. So they start to get emotionally caught up in, hey, I'm only going to be here for a couple more years. I better get my stock options above water, so I don't really care about the long term. And so more and more companies have talked about going private, because if you go private, then you don't have to listen to Wall Street. Then you can make decisions that no longer have to do quarter to quarter. They can be year to decade long strategies. And you look at some of the best companies from good to great and built to last. Some of those companies, what made them there was long-term strategic thinking. The other thing that I also wanted to talk about, boring, is, I don't know if you look recently, but Warren Buffett's partner, Charlie Munger, I think is 98 years old. And at this point in time, doesn't look like he's slowing down. Well, I was taking a look at some statistics here, because when I got my Series 7, Kirk, the gentleman that trained me of the review of the Series 7, he had been a Wall Street trader, and he'd already had a heart attack in his 30s. Another example, in 2008, a Morgan Stanley head of M&A died of a heart attack at 47. In 2013, a hedge fund trader died at 35. In 2018, an ECM banker had done 33 IPOs in 30 months, died of a heart attack in his 50s. All these people are under 60. Charlie Munger's 98. Now, we talk about correlation and causation. but there seems to be a lot more people having heart attacks that are trying to make short-term, emotional, high-pressure decisions in the stock market than those who have more of a long-term, methodical perspective. So, yes, there's multiple ways to skin that cat, but maybe having a more logical, less a promotional approach is not only better for your wealth, it's probably better for your health.
Yeah, I couldn't agree more. Well, that's a good segue to wrap it up, Doug. Final thoughts from you, and where can people find more about you?
I appreciate Kirk. Yeah. Final thoughts for me. Just listen again. I've said I'm not going to go long on a tirade on this, but be disciplined, be logical, have a process. Any process is a good process because a good process is going to look for those right opportunities that are going to be able to work for you. And again, if you are day trading, if you're doing your own investments, I know there's this push these days. As a matter of fact, there's another chart we didn't get to about how the number of investors continue to move from active funds to passive funds. And again, there may be some good argument of active to passive funds, but when you start to look at the allocation of your investments, if you're going from having help to do it yourself and saving money doing that, and again, it may be better for you to outsource getting that help to pull your emotion away. Outsource the surgery to someone else. If you're a business owner, listening, you probably get that. You have so much time, only so much time to spend. You're great at certain things. It's better to outsource other things so you can stay focused on what you do the best and get your emotion out of it. So really think about, there's a cost of anything you do. There's a cost of paying someone for help, but there's also an extreme cost of self-help, of doing it yourself too. You only have so much time and you only have so much emotion. So really look for getting help in these decisions, because you do your day-to-day job, you spend that time with your family. And in the end, is it about doing better in the stock market, Kirk, or is it about having a better life in allowing you to do the things that mean the most to you? Where can you find more about me? One of the ways you can find me is you can find me at ProCollegePlanners.com. ProCollege Planners, we have a business that helps families not overpay for college. Most people are. Again, emotionally, you're making a huge decision, one of the biggest purchases you'll ever make in your life. Tons of emotion tied to this, right? Big brand names, banners, big teams, waves. Everybody wants to go to the great place, make the most money, ultimately be at a great school that's going to help leapfrog them into the next career. Most people make a mistake in this area, pick schools for the wrong reasons. Okay. Again, going back to logic first before emotion, pick your schools academically, financially, and socially. If you have someone in high school right now who is a freshman or older, and you are not getting help through this incredibly complex maze, you are not only setting yourself up for challenges when they graduate, but probably overpaying us too. So find out more at ProCollegePlanners.com, learn how to save money on college, and make sure that your child can have an extraordinary outcome.
Great. And you'll definitely get into a better college than Faber College. That's all I can say. So contact Doug for that. And those of you who didn't know the reference, that was from Animal House. So anyway, that's the show for this week. And I think, the takeaway is, so this week we talked a lot about market cycles. Next week, we're going to get back into inflation. We got a lot of big numbers coming out next week. We had some today. And I think, what's fascinating to me is the narrative that's being pushed back and forth in the media. And we want to talk about it just to give you some perspective. Because I think, if you haven't learned anything this year, learn this, is that when the market's going down, it's the end of the world. When the market's going up, it's a new day and everyone's going to make lots of money. And if you listen to the news, it's pretty obvious. And then the sentiment shifts back and forth. And a lot of people are getting dragged around by that sentiment rather than thinking for themselves, really understanding how these cycles work, which is why we wanted to talk about it today. And I think once you understand it better, you're not going to be as emotionally charged with a lot of the narratives. So next week we're going to get into a lot of that data and talk more. We've got tons of charts that we backed up because of last week, because of the energy episode. But I think we're trying to get the most pertinent topics for you as soon as possible, and then obviously just filter in the other stuff as we can. So that's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.